All right, today we're diving into something a little different. We're going to unpack the playbook of a contrarian crypto trader who goes by Moneytaur. And his whole premise is, well, it's pretty stark. He believes the market is fundamentally rigged. His philosophy isn't about chasing the next big thing, but about understanding how to play a game that's, designed for the average person to lose. So how does he say you're supposed to win?
This quote right here really sets the tone for his entire approach. He argues that all those popular narratives, hodling, diamond hands, they're basically just fairy tales made to mislead you. From his point of view, the market isn't about technology or fundamentals, it's a psychological battlefield. And believing in the fairy tale, well, that's precisely how you lose.
And that brings us to the central question of his whole playbook. I mean, if the game is designed for the majority to fail, what's the path to victory? According to Moneytaur, you don't win by playing harder. You win by understanding the real game that's happening behind the curtain.
This leads us to his core idea. It's not one market, but two, operating at the same time. You've got the game played by the market movers, and then there's the game played by everybody else. He says that understanding which game you're actually in is the first and, honestly, the most critical step.
So here's how he breaks down the players. On one side, you have the whales, but he says they aren't people. They're sophisticated trading algorithms executing with insane speed and zero emotion. Their goal is super simple: extract liquidity. And on the other side, that's the herd, retail traders. The folks who follow the headlines and trade based on fear and greed. And our role in this ecosystem? To provide that liquidity.
And this quote just drives that point home. The idea that millions of us small traders are the ones moving the price, from his perspective, that's a total myth. The market is really driven by cold, calculating programs designed to do one thing: extract profit. This brings us to the first play in his playbook.
Okay, so play number one is all about your mindset. Before you even think about looking at a chart, his first rule is to accept that the board itself, the market environment, is engineered. He argues it's not a level playing field at all, but a landscape that's just full of psychological traps.
So his playbook outlines several of these manipulation tools. News psyops, for example. That's when you see these coordinated headlines pop up everywhere at once, all designed to create a specific emotional reaction. Then you've got scamfluencers, who he says are paid to push narratives that just so happen to benefit the whales. And maybe the biggest tool of all is that hodl fairy tale, which convinces the herd to hang on to their assets, providing the perfect exit liquidity for smart money to cash out.
So, if whales and their algorithms are moving the market, how does that actually translate into a strategy for us? Well, the idea is that they leave footprints. Play number two is all about learning how to read those footprints on the charts by finding the fuel that drives the price. And that fuel is liquidity. Now, this is a huge shift from how most people look at charts. According to this playbook, price doesn't move because of trend lines or some indicator you bought. It moves toward pools of liquidity. These are areas where tons of buy or sell orders are all clustered together. The algorithms are literally programmed to hunt this stuff down.
One of the clearest footprints he talks about is something called an order block. You can think of it as a specific price zone where institutions have placed a massive number of orders. And because they can't get all those orders filled at once, there's a really high probability that the price will eventually come back to that zone. It's like a whale's bet, just left right there on the chart for you to see.
Another key concept is the fair value gap, or FVG. This just represents an imbalance in the market. But here's the contrarian twist in his strategy. An FVG by itself is basically meaningless. It only becomes a powerful magnet for price if it's leading to a pool of liquidity, like one of those untouched order blocks. Without that fuel, the gap is just noise.
The way he lays out his analysis is super methodical. You start with the big picture, on the high time frame charts like the weekly or the daily. That's where you identify the major liquidity zones. Then, and only then, do you drill down into the low time frames to really nail down a precise entry. This whole top-down approach is designed to find those killer trades with high risk to reward.
Okay, so finding a potential trade is one thing, but this next play is arguably the most critical: managing your risk. Seeing the board and finding the fuel, well, that means nothing if you can't stay in the game. And that is all about protecting your capital.
And this really shows the huge difference between the two mindsets. The contrarian play is all about using tight, strategic stop losses. You accept a small, calculated loss as just the cost of doing business. The herd, on the other hand, is taught to hodl, right? Avoid selling a losing position at all costs. But in doing that, they just risk becoming the exit liquidity for everybody else.
And this isn't about feelings, it's pure math. Risk is managed with disciplined position sizing. High time frame plays, which you see as having the highest probability, might get a risk of 3 to 5% of the account. But as you move down to those faster, more volatile low time frame plays, the risk gets cut way down to 1% or even less. This makes sure that no single trade can ever blow up your account.
I think this quote pretty much sums up his entire philosophy on risk. Winning isn't about having a 100% win rate. It's about making sure your wins are bigger than your losses, and that's only possible if you've actually mastered how to lose, intelligently and strategically.
So what's the ultimate takeaway from this whole playbook? It's not some secret indicator or a magic formula. Instead, the final, and let's be real, the most demanding part of the strategy is the price of winning, the sheer commitment it takes to actually achieve mastery.
And this number really puts his view on commitment into perspective. Over 25,000 hours. He is crystal clear that in his system, there are no shortcuts. This is not something you're going to master over a weekend. You absolutely have to put in the screen time.
So this path to mastery, it involves a total mindset shift. It's about delaying gratification and making self-improvement your #1 priority. He's a huge advocate for journaling every single trade so you can find the patterns in your own behavior. And most importantly, you have to understand it's not just about putting in the hours. It's about putting in hours on the right path, not just blindly following the herd.
This might be the most powerful summary of his entire philosophy. That aha moment that everyone's searching for, he says it doesn't come from a secret tip or watching one video. It's earned, he argues, after you push through thousands of hours of hard work and, yes, a lot of frustration.
Ultimately, this isn't just a trading strategy. It's a philosophy of mastery that demands total commitment. It redefines winning not as some single lucky shot, but as the result of a disciplined, contrarian process. So the only question left is, are you ready to play that game?